Today we would start with you chapter 15, which is related to long-term liability. And in particular, I will be speaking with regard to the first learning objective regarding major characteristics of bonds. Okay, so what are bonds? In general, long-term liabilities are obligations that are expected to be paid a year from now. So for example, if you remember, balance sheet is dated 12/31/20. Current liabilities will be any liability that is due within year 2021, basically the year following the balance sheet date. So a long-term liability will be dated January 1st, 2022 and on in the future. So what are bonds? Bonds are a form of interest-bearing notes payable, so a type of notes payable. Usually they're sold in the small denominations, 1,000 or maybe multiples of thousands. Why? Because you can then sell your bonds back. Or it's easier, basically, almost like stocks. Think of a regular dollar amount. If you're carrying $100 bills, it will be very difficult to trade that way. So you've got $10, you've got $5, so the same as here. If you issue a bond in $1 million denomination, it will be very difficult to sell it. They attract many investors. Corporations issuing bonds are actually borrowing money. It's one of the ways to raise money for your business, and then person who buys the bonds, the bondholder, is lending the money. So these are the investors then, and we talk about the investments in chapter 16. Okay, so there are various types of the bonds, so please do review these. I could test them on the exam. It's not that difficult. What is secure bonds? Usually we have an underlying specific asset that is pledged as a collateral for this bond. So if the corporation or the person who issued bonds goes bankrupt, then the bondholder can seize that specific asset. So it could be accounts receivable, it could be inventory, it could be all kinds of various things. Unsecured bonds, also called debenture bonds, are issued against the general credit of the borrower, so opposite of secured bonds. We don't have specific assets pledged. Convertible bonds can be converted into common stock at the bondholder's option. So this is one of the nice features of convertible bonds, that I can convert them into stock. Callable bonds are bonds that issuing company can redeem, call back, or buy back at a stated dollar amount prior to maturity. For example, I could have a 30-year bond, but I can call it at a year 15 because I wanted to do that. Okay, how about issuing procedures? State laws grant corporations power to issue bonds. Board of directors and stockholders must approve bond issue because it's an extra borrowing, right? Board of directors must stipulate number of bonds to be authorized, total face value principal, and contractual interest rate. So basically, what kind of interest rate are we willing to pay to our bondholders? Bond terms set forth in bond indenture, okay, and indenture is an agreement. So basically, bond indenture is a bond contract. Bond certificate specifies name of the issuer, face value, contractual interest rate, and maturity. Here's an example of, in the next slide, you'll see the certificate, what it looks like. So that's why we call issuing procedures, even though we're selling bonds, we actually say issue bonds. Why? Because we issue a certificate. It's a promise to pay sum of money, so principal or par, at a designated maturity date, plus you've got periodic interest at a contractual or stated rate on that maturity amount. Interest payments usually made semi-annually, however it could be quarterly or annually as well, issued to obtain large amounts of long-term capital. An investment company sells bonds for issuing company usually, so it could be a bank. Okay, so that's the certificate I was talking about, and you can see In the middle, it's usually face or par value, right? We have the name of the bond issuer right here. Here's your maturity date. Okay, you can see debenture due May 1st, 20, is it 54? Hard to read. And then here's your contractual, 2024, contractual interest rates was specified on the contract or the bond certificate. Okay, bonds are traded very similar to stocks, so that's why the small denominations are nice. So if you have $1 million worth of bonds, but they're all in a 1,000 denomination, so you can sell some and not your whole $1 million investment as a bondholder. So you can sell it at the current market price, and the prices are quoted as a percentage of face value. So you can see up here, the bond's contractual rate is 6.75. However, current yield is 5.49. Here's the maturity date, and they're closed at 116. So think of it as a percentage. So for example, if you have a $1,000 bond, how would you know how much it is? You'll take your $1,000, right, and multiply it by 116.4%. Then you will know how much you will get for this bond, right? So a little bit more, so it will be 1,164. Okay, and the last one as far as characteristic. How do we determine the market price of the bond? We'll need to figure out the current price or a present value. It's a fraction of or function of three factors: dollar amount to be received, length of time until the amount is received, and market rate of that interest. Okay, market interest rate is the rate investors demand for loaning the funds right now. Okay, and in the next video I will show you how do we actually calculate the current price of the bond, because it's a little bit tricky.